Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global financial markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 135, and in this episode we are reviewing the performance of the global markets during the 47th week of 2024, and that is from Monday the 18th to Friday the 22nd of November. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off at the COP29 climate conference that was held in Baku, Azerbaijan, and which was due to conclude on Friday, but ran into overtime as negotiators from nearly 200 countries struggled to reach a consensus on the climate funding plan for the next decade. However, on Sunday, a hard-fought agreement was achieved in which developed countries, who are the main contributors to pollution and climate change, agreed to an annual finance target of $300 billion that will be used to help developing nations to deal with the impacts of climate change. In the United Kingdom this past week, data from the Office for National Statistics showed that inflation in the United Kingdom picked up sharply in the month of October to a higher than expected 2.3%, tempering expectations of a December rate cut from the Bank of England. The hike in inflation marks a sharp increase from the 1.7% that was recorded in the previous month of September, and also exceeded the economist forecast for an increase of 2.2%. This latest data confirms that inflation is once again above the Bank of England's target rate of 2%, which potentially dampens the prospect for another rate cut before the end of this year. Meanwhile, core inflation, which excludes volatile food and energy prices, this came in at 3.3% for the month of October, which was up slightly from 3.2% in September. On the currency front, the prospect of the United States introducing new trade tariffs has led economists to project that the euro could return to parity with the dollar sometime in 2025. Since Trump's decisive win in the U.S. presidential elections earlier this month, the U.S. dollar index, which measures the strength of the dollar against a basket of currencies, has soared to its highest level in more than 1 year. A proposed 10% universal tariff on all imports and a 60% tariff on Chinese imports is broadly expected to drive up inflationary pressures in the United States. That would cause the Federal Reserve to exercise more caution and to cut interest rates at a much slower pace than was previously anticipated. On Wall Street this past week, Friday marked a continuation of the trend where investors shifted exposure from tech to other sectors of the market, such as industrial and consumer sectors, which caused the S&P 500 to tick up higher. The Dow Jones Industrial Average closed at a new record on Friday, capping off a winning week for the stock market. The blue chip Dow gained 426 points to end the session at a new all-time closing high of 44,296. Meanwhile, the S&P 500 advanced by 0.35% to finish off at 5,969, and the tech-heavy Nasdaq Composite rose by 0.16% to wind up at 19,003, as gains in tech were restricted by declines in both Nvidia and Alphabet. The post-election rally that stalled last week resumed again this week, with the Dow rising about 2% for the week, whilst both the S&P 500 and the Nasdaq each added about 1.7% during the week. In the U.S. government bond market, the yield on the benchmark 10-year Treasury bond edged lower on Friday as investors weighed mixed signals from economic data and assessed the state of the U.S. economy. Economic data released later in the week sent mixed signals about the current state and outlook for the U.S. economy. Investors also assessed the latest comments from Federal Reserve officials, scanning for hints about the likelihood for a third back-to-back interest rate cut at their next policy meeting in December. The yield on the benchmark 10-year Treasury bond dipped by 2 basis points to settle at 4.41%, whilst the yield on the policy-sensitive 2-year Treasury note rose by nearly 3 basis points to level off at 4.37%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equivalent to 0.01%. In the energy markets, the price of crude oil rose on Friday, posting a weekly gain of more than 5% as the war in Ukraine intensified and Chinese oil imports were set to increase in November. This past week, Russia fired a ballistic missile at Ukraine and warned of a global conflict. Ukraine has previously used drones to target Russian oil infrastructure, which raises the risk of supply disruptions from one of the world's largest oil producers. Meanwhile, China, which is the largest importer of crude oil, announced policy measures to boost trade, including support for energy imports. For the week, the global benchmark Brent crude gained nearly 6% to close at $75.17 per barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, finished higher by about 6.3% to finally settle at $71.24 per barrel. In the precious metals market, the price of gold broke above $2,700 for the first time in over 2 weeks and was on track for its biggest weekly gain in nearly 2 years as safe haven demand outweighed dollar strength and reduced expectations for a rate cut at the Fed's next policy meeting in December. The escalating conflict between Russia and Ukraine is boosting the safe haven demand for gold and has lifted its price from a 2-month low that was hit last week. Gold tends to outperform other assets during periods of geopolitical tensions and also does well in a low interest rate environment, given that it does not provide a regular coupon like a bond. This past week, the price of spot gold surged about 5.7% and eventually came to a close at $2,709 per ounce. In the cryptocurrency market, Bitcoin breached $99,000 for the first time on Thursday as investors continue to price in a pro-crypto administration with the election of Donald Trump. Bitcoin has been hitting fresh record highs this month on hopes that Trump will usher in a golden age for crypto, which would include more supportive regulation for the industry and the potential for a national strategic Bitcoin reserve. Investors took profits in crypto stocks amid a broader rotation out of the tech sector. The price of Bitcoin is widely expected to reach $100,000 before the end of this year. And according to CoinMetrics, the price of the flagship cryptocurrency hit a high of $99,046 before correcting slightly to settle at around $98,273 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week the shilling depreciated marginally versus the US dollar, and according to data obtained from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.52, whilst the sterling pound was priced at 164.08, and the euro was valued at 136.78. And on the regional front, one Kenyan shilling was changing hands for 28.49 Ugandan shillings and 20.48 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.65. The central bank has finally decided to release its firm grip on the dollar-shilling exchange rate, as it allowed it to dip slightly from 129.35 the previous week to 129.52 this week. The previous price action, where the dollar-shilling exchange rate was flat at 129.20, was both unrealistic and unsustainable. The central bank should stay out of the forex market and let the shilling find its optimum rate through demand and supply. The central bank has previously stated that it does not have a target level for the dollar-shilling exchange rate and only intervenes when there is extreme volatility in the forex market. That said, the long-term outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined by $132 million, down to an amount of $9.14 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that has pushed the country to the precipice of a sovereign debt default. In the interbank market, during the past week, the interbank market was sufficiently liquid and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this remained stable at 11.87%, which was the same rate that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market increased to 29.2 billion shillings, up from 27.5 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 48.4 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 21st of November, and the central bank received bids totaling 77.2 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 322%. The central bank, however, ended up accepting only 46.3 billion shillings, and the results of the auction were as follows. The 91-day rate fell sharply by about 75 basis points to average out at 12.03%, whilst the 182-day rate followed suit as it dropped by 85 basis points to close out at 12.20%. And the 364-day rate was no exception as it declined by 60 basis points to settle at 13.29%. In the primary bond market, the Central Bank of Kenya, acting in its capacity as fiscal agent for the government of Kenya, has published its prospectus for the December bond issue, in which it is looking to raise a total of 45 billion shillings for the stated purpose of budgetary support. In this regard, the central bank is now inviting bids for the following reopened fixed coupon treasury bonds, whose terms and conditions are as follows. The first bond is FXD1/2023/10 with 8.2 years left to maturity and a coupon rate at 14.15%. The second bond is FXD1/2018/20 with 13.3 years left to maturity and a coupon rate at 13.20%. And the third bond is FXD1/2024/10 with 9.3 years left to maturity and a coupon rate at 16% flat. For the first two bonds, the central bank is looking to raise a total of 25 billion shillings, and these bonds are now open for sale until Wednesday, the 4th of December. As for the third bond, the central bank is looking to raise an additional 20 billion shillings, and the same is open for sale until Wednesday, the 11th of December. At the Nairobi Securities Exchange, during the week, the equities market was on a downward trajectory, with the NSE 10 declining the most by 2.9%, whilst the NSE 25 dropped by 2.4%, and the NASI and the NSE 20 both fell by 2% flat. This takes the year-to-date performance to gains of 31.9% for the NSE 10, 30.6% for the NSE 25, 25.3% for the NSE 20, and 22.6% for the NASI. The market's performance was mainly driven by losses recorded by large cap stocks such as Equity Group, Stanbic Bank, and Bamburi Cement, which declined by 7.9%, 5.9%, and 3.4% respectively. These losses were, however, mitigated by gains recorded by other large cap stocks such as Standard Chartered Bank, NCBA Bank, and DTB Bank, which increased by 2.1%, 0.6%, and 0.5% respectively. On Kenya's national debt, according to the latest data obtained from the Central Bank of Kenya website, Kenya's national debt as of September 2024 stood at 10.79 trillion shillings, and this was divided between domestic debt, which stood at 5.6 trillion shillings, and foreign external debt that is valued at $40.16 billion, which is equivalent to 5.18 trillion shillings. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product, and given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. In other news, on Wednesday, Gautam Adani, who is the chairman of the Adani Group and one of the world's richest people, was indicted in New York's federal court on charges related to massive bribery and fraud over his alleged role in a scheme to bribe Indian officials in order to secure power supply deals. The following day, that was Thursday, Kenya's President William Ruto, during his State of the Nation address, ordered the cancellation of the deal to lease Jomo Kenyatta International Airport to the Adani Group, and also cancelled a public-private partnership between the Adani Group and the Ministry of Energy for the construction of power transmission lines. Up next is our topical issue, and this week we're looking at the budget review and outlook paper for the next financial year. Just when you thought the issue of taxes was over, the Treasury has signaled the introduction of new tax measures as it seeks to raise an additional 343 billion shillings for the next financial year, which raises the risk for a fresh round of public demonstrations. The Treasury appears not to have learned their lesson, as demonstrations earlier this year led to the withdrawal of the Finance Bill for 2024. This bill had also proposed to introduce new tax measures with the intention of raising an additional 346 billion shillings for the current financial year. However, this bill never saw the light of day, as Kenyans across the board unanimously rejected the bill, given the burden of existing taxes and the high cost of living. The withdrawal of the Finance Bill 2024 inevitably led to an increase in the fiscal deficit, which in turn put more borrowing pressure on the government. This did not augur well with the International Monetary Fund, which is pressuring the government of Kenya to increase its tax collections in an effort to reduce its current level of borrowing. According to the Budget Review and Outlook paper for the next financial year, the Kenya Revenue Authority will be required to collect a total of 2.73 trillion shillings, which is a 14% increase from the target of 2.38 trillion shillings for the current financial year. The revenue outlook that is set out in the budget paper lays out a three-pronged approach that focuses on the introduction of new taxes, as well as the aggressive pursuit of tax evaders and the roping in of traders in the informal sector. This budget review and outlook paper is the precursor to the Finance Bill for 2025, which will be tabled in Parliament in April next year, in order to facilitate the funding of the proposed 4.32 trillion shilling budget for the next fiscal year, which starts in July 2025. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, price is only an issue when value is absent. Think about it. Thank you, and God bless.